Oh boy, do we have an exciting video for all Tesla stock investors today. This one's a little bit different because we just got another round of recessionary data. So instead of looking at the best possible outcomes for Tesla stock in 2024, let's talk about the worst case scenario, because I think that's even more important than your best case scenario. What could happen if things go really bad in 2024? Now, to the contrary, I also want to give something to the bulls as well. I expect there will be a great shift of capital. Now, this is capital that is in cash, in bonds, on the sidelines, in bank accounts. There's a lot of money out there. And simply put, it has not been allocated to stocks, and you're finally starting to get some data that shows allocation is returning to stocks. On top of that, there are three very specific sets of criteria that I think you want to follow to a point in 2024 to make a whole lot of money. And we'll go over those three here in this video. Let's go ahead and get started. We have an exciting jam-packed one for you here this evening. Hit the like button and subscribe to the channel. It costs you absolutely nothing to do, and I know you want to see your fellow Tesla investors succeed. So share this video with a friend, as well as like the video, subscribe to the channel. That helps dramatically. I cannot underestimate that. Push this video out to even more people. And I want to say a quick congratulations to everyone that is a part of the trading community. We hit a over 1,000% winning trade on target and over 450% winning trade on applied materials in this past week alone. So congratulations. I know a lot of people made a lot of money on those trades, but nonetheless, let's go ahead and get started. So let's start with a little of this bad news, this kind of recessionary data that is coming out today. This data is from Adobe Analytics, and it says early Black Friday discounts were far higher this October compared to prior years, a signal that retailers could be worried about holiday demand. Take a look at this. So your dark blue is 2023, your light blue is 2022, and your gray is 2021. You can see basically nothing had big deals in 2021. There was a lot of capital. People were doing fine. They were literally giving free money out to basically everyone. Computers saw the biggest discount, about 5%. Now in 2022, electronics had big discounts at 17%, and toys had big discounts in October at 15%. Other than that, every other category is seeing a larger discount in 2023. Apparel, 9%. Appliances, 6%. Computers, 13%. Furniture at 5%. Sporting goods at 7%. Televisions, 8%. And then toys, again, that's only 5% compared to 15% for 2022. And electronics, which is 12% of a discount for 2023 compared to 17% for 2022. We'll see for the month of November. I think the discounts are going to be a lot larger, but it's kind of pointless because the prices are still higher than 2022 anyways, even though they are giving these discounts. So take that as you will. It's not necessarily saying prices are a lot lower than 2022. Just the discounts are a lot steeper. Now, online sales grew 6% to $76.8 billion compared to last year and was fueled by deep discounts and an uptick in buy now, pay later use, which allows customers to split up orders into 4 payments, according to Adobe. Last year, about 30% of overall holiday sales happened online and other non-stores versus physical and retail locations. So this data so far, up 6%, is a pretty good sign, but all of these discounts is alarming. Look at this chart. The average retail discounts in the US for the month of October. 2019 and 2020, you were at 17%. In 2021, you dropped to 13%. And in 2023, you're at 24%. 2022 was at 20%. So from 2021 to 2023, you are up, or technically being more discounted, 11% more than 2021 for the month of October. That's not exactly screaming 5% GDP like we just got. That's not exactly screaming the economy is doing great and the consumer is just fine. This is usually what happens before you head into a recession. Usually you get discounts. Usually there are companies that don't have as much pricing power that really have to start slashing prices. We just heard from Walmart as well. They reported their earnings last Thursday in pre-market. There was a lot of notable headlines from the conference call of Walmart. Some of the most notable ones was that customers are leaning heavily into discounts and that we may be managing through a period of deflation in the months to come. And while that would put more unit pressure on us, we welcome it because it's better for our customers. Deflation is worse than inflation. If there is anyone that would know whether inflation or deflation is coming, it's a Walmart. Let's just be 100% honest with ourselves. The Fed doesn't know crap. Your favorite analyst doesn't know crap. I don't know crap. Walmart knows crap, okay? They're the ones that, they're the most interconnected retailer in the planet, right? That sells things at a brick and mortar retail store. They know how the consumer is doing, whether they're buying low end, high end products, whether they are buying discounts or not. Well, deflation is very bad for an economy. It's way worse than inflation because I've explained this before, but I'll explain it again. It's like a circle, right? You get companies cutting prices. You get deflation. If you get that for an extended period of time, companies start to lay off employees because they're bringing in less revenue and less profits, presumably, because they are cutting prices. Then those people that are unemployed now, if they cannot find a job immediately, which there are a lot of job openings, almost 10 million job openings, so that's not a huge problem right now. But if times were to get even worse and the outlook were to get worse for 2024 from here, well, those people that are now laid off cannot buy those products. And then you get companies cutting prices more and then laying off more. And then those people that are now laid off again cannot buy products. It is a loop, okay? Until the situation stabilizes and starts to get better in the economy. That's why deflation is so bad. If companies raise prices, they can hire. They're bringing in more money. The consumer is hurt. Right? But at least they have jobs. I guess that's the positive side to inflation. Inflationary periods are usually good times for an economy. Deflation, not so much. A matter of fact, over the last 900 months, guess how many months we have actually seen a deflationary CPI report? 30. That is 3% of the time. Do you get a deflationary period of time or a deflationary inflation report? It doesn't happen all too often. Last month, you were at 0%. You're pretty close to deflation. And if these October deals are actually what's happening out there, and there is 24% discounts now compared to, was it 20% last year? You could actually start to see some deflationary numbers coming in for your CPI report. That's great for Fed policy, not exactly great for the economy. And I know this sounds contrary to what you would think. You would think prices falling at least a little bit would be good news for the economy, good news for consumers, but it's not because it means more layoffs. And layoffs, people losing their jobs, that's really the thing that matters here. Credit card debt being at a new all-time high, all of these different things, auto delinquencies, none of that matters. Ultimately, it's about whether or not people have jobs. If people start losing their jobs, that's when a problem turns into a crisis. Unfortunately, right now, there's no way to tell whether or not we go into a recession or how bad a recession would be. Myself, I'm actually optimistic. I don't expect a great economy for 2024, but I'm not expecting a doom and gloom scenario because most recessions are kickstarted by a problem happening in the economy, right? Whether that is the banking crisis in 2008, whether that is the stock market maker failure of 1987 that caused those recessions, right? Whether it is all the different recessionary periods we've had. Basically, there usually is at least one event that kick-started all of that. You could say the banking crisis earlier this year could have been that. The bank The central bank came to the rescue, injected $400 billion into the system. That doesn't look like it's going to turn into that recessionary catalyst. Who knows? This time could be different. Infamous last words. But usually there is something big that happens that starts a recession once the weakness is actually here. I would argue the weakness is already here. I would argue I just don't see the catalyst that pushes us into that recession, that changes the dynamic in people's minds to say, hey, we're in a recession. Am I about to get laid off? Should I be spending less money? That's the thing you want to be watching out for heading into 2024 and then ultimately into 2024 and even in 2025. And the good news is if you are a long-term investor in our markets, well, you should welcome a recession or a period to be able to buy stocks at cheaper prices. The longer that sucker takes to come, the more money you will make because presumably the more cash you will have on the sideline. So right now, I'm selectively buying, but I'm keeping a lot of cash on the sideline. Recessions have created far more millionaires than lottery winners, and that's exactly why the people with capital do very well during recessions and proceedingly coming out of recessions. Whereas if you're not in that scenario, if you're not in that position because you did not prepare for these things, well, that's a problem. Even if I don't think it's likely we head into a recession, I could be wrong. I think there's probably a 30% chance we head into a recession and probably a 60% chance we head into a period of really stagnation, right? Stagnation is not stagflation. Stagflation would be high inflation, stagnant growth. I think low inflation, stagnant growth. That's what I'm expecting. I'm not expecting crazy growth. I'm not expecting a huge decline. I'm not expecting a lot of inflation. I think inflation is basically dead at this point. That's my personal opinion. I think there's a 60% chance of that. Well, hey, 60 plus 30, that's 90%. I think there's a 10% chance we go into a deep recession, that something does happen out there that takes the markets by surprise, that takes people by surprise, that causes people to really pull back, and you see another '08 financial crisis again. Something along those same lines. I don't think that's that likely. Maybe even 5%. I say 10% being more generous to the bears out there. There is something that I'm really the only one to talk about. I watch a lot of financial media. I watch a lot of financial creators. I like to get a lot of different opinions, look at the data, look at what's going on out there in real time, come to my own conclusions, kind of mix everything together so I have the bull, the bear perspective. There's, I believe, nobody else out there that has a wider perspective of what's going on out there. To the bull side and the bear side. I take in all opinions equally. I don't discredit anyone when I hear their opinions. Some things just make absolutely no sense, like the bears in Tesla stock. Makes no sense at all. There's no logical reason why Tesla would grow at 10%, even if you do go into recession. If that 10% likelihood outcome did happen, well, sure, Tesla could grow at 10%. We'll talk about that towards the end of this video. I want to get into something that I think could be called the great shift of capital. Now, think about it like this. Over the past 2 years, the Fed has been raising rates, making it more attractive to keep cash out of the stock market. That is by design. That is exactly what the Fed wanted to do following 2021 and when everyone wanted to put their money into stocks. And they have been successful with that. There is record low allocations to stocks right now. That's the simple fact. There's not a lot of people investing in our markets. Simply put, if my 60% odds of stagnation, not going into recession, and 2% inflation come true in 2024, then you will see a lot of money flow from the sidelines, not in our markets, back into our markets. And where do you think it's going to go? It's going to go in stocks that fit these three criterias. Number one, well-known companies, your brand names, your household names, small, mid-cap, large cap, does not matter. Number two, stocks and companies that will benefit from rates going lower, whether directly or indirectly. What I mean by that is directly, companies that would benefit from rates falling would be financing companies like a SoFi that issues loans. They would benefit directly from rates going lower. A Tesla would benefit directly from rates going lower. That would be their customers, right? If their customer base is dependent on rates, If rates went to 20%, nobody's buying Teslas. Let me tell you that right now. Their numbers would be way, way, way lower than what you're seeing today. If rates went to 0%, Tesla's numbers are going to be a lot higher than where they are today. That's a simple fact of the matter. Tesla would probably have a backlog that would be ridiculous if rates went back to 0. So that's directly benefiting. Indirectly benefiting is like a Fubo, right? That's another company that I own that loses money, that needs to refinance debt, that needs to issue capital or issue debt via the bond market that would be able to at lower rates, right? That's indirectly. Really, the back end, like bonds benefiting from lower rates, which would be a vast majority of your small and mid-cap companies. Now, not a lot of small and mid-cap companies, or really any companies that are highly sensitive to interest rates, are household names. That's why I'm an investor in Tesla, Fubo, SoFi, PayPal. These names will all benefit directly, or Fubo's case, indirectly, from rates going lower. And I think that's where the capital allocation is going to be. Now, Tesla, I think, is by far the best stock to own out of all of those, because it has all of what we're talking about, right? Tesla benefits directly, indirectly. Their multiple can actually expand. And there's an aspect of quality. The third thing of this criteria is companies that have been improving over the past 2 years, which all of those companies have that I previously just mentioned. Tesla as well. Tesla's had to cut prices because of interest rates, and I do think Tesla will raise prices when rates come down. So I think Tesla will see a rapid improvement in 2024 in its operations, right? In its auto gross margins, things of that nature. Whereas Tesla's, like, if you look at Tesla's balance sheet, if you look at even the growth still, Tesla just grew 9% year over year. That's not bad compared to Apple that's negative year over year for 4 quarters in a row now. Tesla's still doing pretty dang good, regardless of the headwinds that they are currently facing. But I think Tesla's a little bit different because it's going to see a rapid reacceleration in the business, a rapid reacceleration in auto gross margins with the introduction of the Cybertruck, as well as broad price increases across the entire line of Teslas. Elon made it clear in the last earnings call. I hate that Wall Street has not picked up on this. Elon made it so clear it's stupid. The only thing that matters is the monthly payment. People don't care if they're financing a $100,000 vehicle, a $200,000 vehicle. If it costs $500 a month, who cares? Or if you're financing a $25,000 vehicle that costs $500 a month, who cares? Nobody cares. Customers don't care. They care about the monthly payment, whether or not they can afford that. That's why a $65,000 Model Y, well, that doesn't work anymore because you would have an $800-900 payment a month. Doesn't work. You had to cut prices. You had to sacrifice margins to keep a reasonable payment so people can buy these vehicles. When rates go lower, Tesla's going to raise prices. You bet your ass on that. I will bet my entire portfolio on that. I'm not a financial advisor. I'm not a financial planner. Obviously, I love to gamble. So it's just my opinion. Let me know what you guys think on that down below in the comment section. But these 3 criteria, again, are well-known household names that basically like 80% of anyone you talk to would know about. Companies that benefit directly or indirectly from rates going lower. Again, directly would be like their customer base is dependent on rates. Indirectly would be financing, bond-related, issuances of debt. And number 3, improving companies over the past 2 years. A lot of companies have improved over the past 2 years, regardless of the rate situation. I would argue Tesla, right? Look at Tesla's balance sheet. I mean, they're a fortress now, much better than it was 2 years ago. SoFi, Fubo, PayPal, they've all been doing well. Just the rate environment, the straining of capital has killed these stocks. That's what it is. It's not anything to do with the business itself. Same thing for Tesla, I would argue. And you are starting to get some signs this great capital migration or inflow, I don't care what you want to call it, just a massive amount of money moving off the sidelines back into stocks has actually started. So this is a chart. I think the best chart to actually show this, a matter of fact, of inflows and outflows to treasuries. Now, outflows to treasuries are good because if you're outflowing taking your money out of treasuries, you're putting it into other assets, right? If that's investable capital, you're taking that money out of treasuries, you're putting it into stocks, you're putting it into crypto for that matter, real estate, whatever it is. Most of the time, treasuries, stocks go hand in hand. So what you'll notice from this chart is anytime that you see real outflows to treasuries, tends to be pretty dang bullish for stocks. Notice this period in particular right here. From 2019 through 2021, you had a lot of outflows to treasuries. Now, during times of fear, right, like 2020, you see big inflows to treasuries. But generally speaking, you've seen a lot of outflows to treasuries during this time. And you were under this zero line, this black line, for a majority of the time during this 3-ish period. Take a look at what the markets did during that time for the triple Qs. From the lows of October 2019 until the beginning of the Rona in about 4 months, the NASDAQ went up about 31%. Absolutely crazy. Now, if you look at that and compare that to 2021, the peak, your good old NASDAQ from the October 2019 lows went up about 112%. A lot of that, I would argue, was because people thought they could make better returns in stocks. And you were seeing outflows from treasuries. That's been drastically different over the past 2 years or so, 3 years or so. Look at all of the inflows to treasuries. It's been ridiculous. And you finally, for the first time in over a year now, seen the first week of outflows to treasuries. This is on a weekly basis as well. I should point that out. And this dark blue line is the 4-week moving average. Finally, you've started to see a change here. And I think this probably continues from here. But if you do look at CTA positioning in US equities, you went from extremely low levels of positioning, like your Rona lows, your 2018 crash lows, really, really low levels, right? -70. So not a lot of people were allocating to stocks at all. And now you have seen this to +70 in the quickest reversal of trend here. So don't be surprised if markets do trade sideways or pull back slightly from here. I don't think this migration of capital, this transition or shift of capital is over. I think it's just getting started. These big money funds, these funds with billions of dollars, they don't move their money around overnight. They need confirmation. They need validation. They need to be cradled like a baby before they make big actions. You are a retail investor. You have the power to move your money around instantly and to position instantly. I think that is vital here. The 2 ways you beat out Wall Street is by seeing things first before Wall Street. That's why we've been pretty successful recently just predicting what Tesla's going to do. I know that's small in the grand scope of the markets, but we've been spot on with delivery numbers. We've been spot on with where Tesla stock has went from a week-by-week basis. That's because we're seeing ahead of Wall Street. We already know the catalyst. Wall Street hasn't even priced them in. When we got news that Tesla is potentially entering into India, Wall Street took that as the craziest news. Tesla stock was up 7% the next day. We already knew that was coming, right? So positioning before Wall Street figures it out, which is exactly what I'm trying to show you right now, this allocation to small mid-cap stocks, interest rate sensitive companies that will be the ones to outperform in 2024 with almost a certainty. Not a financial advisor, not a financial planner. Make your own decisions with this information I'm providing you. But I think it's pretty clear. Number 2 is by holding. That's it. Because a lot of funds, they don't hold long-term. That's the only way you will ever beat Wall Street in this game. Get the information first, which is almost impossible. At least position first, which is very reasonable. We're doing that right now. And then number 2 is holding long. That's it. Simple as that. You will get very wealthy if you can do those 2 things. And I think this is another moment in time where you have an opportunity to do just that, where it looks very clear on what is coming next. This shift of capital. And Wall Street just hasn't figured it out yet. Now let's just run a couple numbers here and let's calculate a worst case scenario for Tesla stock. So right now, Wall Street is pricing in $3.92 of EPS with a PE of about 60. That puts Tesla stock at $235.20. Tesla stock is currently at $234. So pretty much right on what Wall Street is pricing in right now is that 60 times forward PE. Now, let's say that 10% likely outcome did happen. Let's say Tesla comes in with EPS around $3, right? It's not going to be negative, anything like that. Like $3 would be a really bad scenario for Tesla. Let's say there's multiple contraction as well. Let's say the PE hits 50. Just all things go bad. Then you're looking at a Tesla stock at 150. That is like one of your worst case scenarios. That would be a really bad, dude, that would be like 30% declines year over year. That would be horrible for Tesla stock investors. I don't think that is likely, but that could be a possibility, I guess. In the grand scope of things, 150, 234, what is that? $80 off. It's not that crazy. We've watched the stock go from $400 to $100. Is an $80 drop from here too bad in the grand scope of things? Probably not. That would be a great buying opportunity in my personal opinion. But hey, I ultimately don't think that's going to happen. But if there were to be fears of a recession, usually the fears of heading into recession are worse than the actual recession. If you're looking at just mild recessions throughout history, the markets are a machine of forward-looking pricing. So if we start to get more recessionary data and it starts to suggest maybe strongly that we are heading into a recession, Wall Street will start to price that in. It wouldn't surprise me if Wall Street assigns Tesla 50 times PE and a $3 EPS and we get Tesla at 150. It wouldn't surprise me to see that kind of fear actually happen at some point now in the next 6 months or so. Maybe towards the end of 2024. Who knows? But it wouldn't surprise me. Now, I don't think a recession is coming. So I think Tesla's numbers are ultimately going to be much better than that. Around $5.50 of EPS with a 70 times multiple. That's going to put Tesla stock at least, we can go ahead and do the calculation here, at $385 by the end of next year. You could see an 80, 90, 100 times multiple if we avoid a recession, which I think 60% chance we ultimately will. So I am much more bullish than 150. But in the near term, those numbers could be possible. So let me know what you guys think about this down below in the comment section. Hit the like button as well as subscribe to the channel on your way out of this video. If you guys would like to come trade with us live in real time, link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.